Hello and welcome to another episode of the Uranium Market Minute. My name is Justin Hune. I am your host. Today is Thursday, December 2nd, and this is episode number 43. Thank you so much for tuning in. Before we get into it today, nothing in this video is intended to be investing advice. I'm not your financial advisor, and this is not financial advice. Please always do your own due diligence when it comes to investing, and always take responsibility for your own actions. Thanks again for joining. I had about a week off. I visited some family for Thanksgiving. I had a nice holiday, even though we were caring for ailing grandparents, which is, one of those harsh realities of life. Not fun, but I'm glad that I was able to have the opportunity to visit them. I hope that you all had a good week and a good Thanksgiving if you're in the States. And if you're not, hopefully you had a good holiday from the markets on Thursday and have maintained your composure through a difficult market. I'll get into that in a little bit, but let's go ahead and jump right into the daily scoreboard. The spot price of uranium today is $45.50 per pound mid-market, down about $1.75 from when we last spoke, which was 1 week ago last Wednesday. All of the data I'm going to give you here is for the 1 week totals since last Wednesday, since I have not done a market minute since then. Over the last week, the Sprott Physical Uranium Trust has only taken in $144,000 of new capital since it had almost consistently been trading at a discount to its net asset value. If you recall, they need to trade at least a 1% premium to their net asset value in order to issue shares into the market, raise cash to buy physical uranium. However, over the last week, they did use money from their treasury to purchase another 300,000 pounds of U3O8. At this point, since their ATM went live August 17th, they have purchased an average of over 300,000 pounds per day. They closed at a discount to NAV, yesterday's close at a minus 6.08% discount to NAV. I believe that's the largest discount to NAV that we've seen for the SPUT vehicle since the launch of their ATM. Typically, these deep discounts to NAV trigger some investor interest to come in and at least arbitrage that discount to NAV. I believe that's going to happen shortly here. The SPUT's treasury still remains at a healthy balance of 32 million in cash. Since the 17th of August, when their ATM went live, Sprott has acquired 22.8 million pounds of uranium and has raised 994.7 million in new capital, just under $1 billion in barely over 3 months. As we mentioned last week, they are now authorized to issue up to 3.5 billion on their ATM. They have a long ways to go, and they will get there. Let's turn to the sector equity ETFs. So far reported in the last week, URA reported a decrease of 105,000 shares. URNM recorded redemptions equal to 100,000 shares. These ETF flows gave rise to mandated selling equal to about 6 million, which is surprisingly small considering the moves we've seen in the market. I believe in the next couple of days, we'll see reporting of more shares redeemed by these two ETFs, which is largely what creates that flywheel effect, both on the positive and the negative side, right? The money comes into the ETFs, they're buying their holdings, flows out of the ETFs, they sell their holdings. Just kind of how it works. So you get that negative flywheel effect when we have these corrections like we've had over the past couple of weeks. Because of the pullback in the sector, the AUMs of the two ETFs dropped by about 200 million. The decline in the combined AUMs is almost solely due to portfolio depreciation, not due to redemptions in shares. The two ETFs now have a combined AUM of 2.1 billion, a drop of about 400 million from their November high point, not insignificant. Let's take a look at the charts. Starting off, as we always do, with URA, the largest ETF in the uranium space, you can see we've had a pretty steep decline over the last few weeks. This started out at what looked like to be a higher low correction, which is what I was expecting. However, it continued to decline, especially starting last Friday with a big sell-off. This primarily came due to a thinly traded market on a short day, with new concerns over the Omicron variant of the coronavirus. I'm not going to go into that under my own personal feelings about that, but it sure appears that the market is at least pricing in some concern about governments taking actions and potentially imposing more lockdowns, business closures, etc. I personally don't believe it's going to happen as much as it did last year. I don't think we're going to see another March 2020. But obviously we did see overall sector weakness in multiple sectors. Uranium was not spared. And with these volatile sectors like uranium, we'll see beta to the upside and the downside. So a day that you'll see the S&P or the Dow down 1 or 2%, you might see uranium equities down 5 or 6%. It's just kind of how it goes. The volatility works in both ways. However, it does look like we are trying to find a bottom here. MACD is about as low as it's been since March of 2020, seeing a little bit of a reversal in the RSI, although we've seen the RSI be a little bit lower in the past before it reversed. We'll have to see. It does look like a reversal is in the works. We've made three slightly higher lows since it bottomed out 2 days ago. We're not seeing huge volumes come into the ETFs today. We did see decent volume selling the previous 2 days, which is why I think we'll see more shares redeemed reported in the next couple of days. I'm hopeful. I would like to see that that we stay at a higher low here. That would be a good sign. Just wanted to note out as well, we did see a bit of negative divergence in the RSI in this previous run up. And that did eventually turn into a bit of a sell-off. I'm going to speak, instead of doing a mailbag question, I'm going to speak about market psychology, so I won't get into it right now. But I will say this, we're down about 25% from the high print to today in URA. URA is flat since October, the period of seasonality that I was expecting. Now, this average seasonality typically happens over the course of about 3 to 5 months. So we have at least another 2 months to go, where I believe we will still see some strength come into the sector. If we don't, that is okay, in my opinion. This is a long-term investment for me. And this is what we have always recommended to our subscribers, is that this is a 2 to 4+ year investment. I actually think recent developments, based on what I've spoken a bit about the previous week, that were elucidated in Art Hyde's piece on the spot market, in this concept he refers to as the reverse carry trade. More liquidity has come into the spot market in the near term, but that's pulling pounds from the future. It's a somewhat of a complicated concept to explain, so I'm not going to get into it right now, but I do think that we are setting up here for a serious supply situation. I got deep into the detail on this in the monthly newsletter we released this morning before the market opened, explaining my takeaway from that reverse carry trade concept and what I think is likely to play out for this market. So let's go ahead and let's take a look at the Sprott Physical Uranium Trust. This is a much healthier looking chart than a lot of the sector. We've got this big bull pennant forming here over multiple months. And like I mentioned, most of the time, these types of patterns will break out in the direction of the overall trend. Will we see a bit more downside here? Sure, it's possible. Although most of the time, as I mentioned last month, the month-end smash, as they often call it in the uranium market, is when the traders who get forward month pricing based on the month-end closing price will manipulate the market down as much as they can the last couple of days of trading in order to lock in a lower price for their forward month offtakes. We did see that a little bit, although only down $1.75 in the past week. That's not terrible for the spot price of uranium. This is a pretty good looking chart, and considering the 6% discount to NAV, this is probably a good risk reward play. Taking a look at Cameco, one of the larger caps in the space, again, trying to make that higher low from that previous consolidation period. I don't expect the sector to make a V recovery. I don't expect this to be a dead cat bounce. What I would like to see is a healthy consolidation sideways, a recovery in the spot price, and a move back up, breaking that higher high that we saw in the spot price back in early September of $52 a pound. I would like to see us reach that level. So I'm going to go ahead and just talk really briefly about investor psychology, because there's been a lot of chatter on Twitter about this particular sell-off and where is seasonality. You said there'd be seasonality. Well, first of all, I never would and never have recommended short-term trading in this market. It's extremely, extremely volatile. And as far as I'm concerned, I've mentioned it many times to you all on the podcast, as well as our newsletter members, that this is a long-term play for me. And we recommend that new entrants into the sector enter in tranches. So if you entered the sector 3 weeks ago and went all in at the highs, that's not something that I have, nor would I never would recommend. Enter in tranches and take advantage of the weakness. Most of the time, if you spread those tranches out, even over the course of 1 to 2 months, you will experience some level of a pullback. Now, if you can't handle a 20 to 30% decline in your portfolio, you are in the wrong sector, straight up. That is just how it is for volatile sectors such as crypto, such as uranium, such as gold and silver. There's plenty of other spaces, especially in the resource and commodity spaces, that are highly, highly volatile. And it takes a lot of conviction and it takes thick skin to weather it. So I'm going to read a quick little passage from one of my favorite books, Most Important Thing by Howard Marks. At the extremes, which are created by what most people believe, most people are wrong. Okay. The follow-up point to that, therefore, the key to investment success has to lie in doing the opposite, in diverging from the crowd. Those who recognize the errors that others make can profit enormously through contrarianism. Now, I've mentioned multiple times that this is no longer a contrarian trade, but we will have moments of contrarianism within this bull market. This is one of those moments. When you see selling that is overdone in a sector that is not fundamentally changed for the worst, in fact, it's fundamentally changed for the better over the course of that sell-off, then you should know what to do. If you came into this sector with a set amount of funds to invest and you were already all in, there's nothing to do other than sit on your hands. Of course, the opposite is true for that point I just made from Howard Marks, that buying on the weakness and doing the opposite of the crowd, the same thing goes for when things are euphoric. So when we see the next strong legs up, if you feel that everything is euphoric and you're stressed out about the risk you're exposed to based on the wild swings in your portfolio, then you need to think about doing the opposite of what the crowd is doing at that time as well. That's taking some chips off the table. So far, we have traded in and out of multiple positions. We have only continued to add on weakness. This is a long-term play for us. Is the bull market over at $45 a pound? No. Are we likely to see a strong multi-year energy and commodities trade based on inflation that we're seeing? Yes. Are we positioned for that? Yes. Is uranium exposed to and affected by changes in washouts in the broad market? Absolutely. That is probably the biggest risk to this investment, more so than a nuclear accident, is a broad market washout. Is it going to happen? I don't know. Eventually, it probably will. However, what we focus on is the fundamentals of the sector that we're invested in, which is uranium. Of course, we recommend diversification. I personally am diversified across multiple sectors, but most of my eggs are in the uranium basket because it's the sector I know the most. So all of that said, it's very, very important to look back. Go ahead and look back at the previous bull market in uranium. You're going to see multiple heavy corrections in the market. There was a correction that was close to 50% that lasted almost a year and a half during the bull market. I guarantee you that shook out probably 85% of the people in that trade. It's very difficult. Look at the corrections in the Bitcoin market, for God's sake. I mean, how many people held on that bought early to this level? I would say basically zero. Most people will take enormous gains off the table, or they'll get shaken out when it draws back. It's just how it works. And so during this bull market, we are going to have 20, 25, 30, 35, maybe even 40+% corrections. It is going to happen. And you have to have your plan on how you plan to deal with that. So with all of that said, I hope that you all have hung in there. I hope you didn't get shaken out. What the market likes to do is shake out what I like to call the late money. So that's these are usually more touristic investors that have just heard about this sector and they're really excited about it because there's all of this fervor that's coming from people like me and people like, there's plenty of people on Twitter talking about how great this investment thesis is, which it is. And they just get a little bit too excited. Maybe they go all in at the highs and they get shaken out because it didn't work in the short term. Don't plan on things working out in the short term. Okay. That's the best piece of, that's the best, I was going to say advice. It's not really advice, but I guess that's not investing advice. Ignore the short term. If you want to play the short term, look for places to position, not necessarily to trade around. This is a long-term market. We are looking at least 2 to 3 years. It's probably going to be more like a 4 to 5 year plus investment, especially considering some of the liquidity that's coming in the spot market via this reverse carry trade could slow down the speculation in the short term, but provide for a much larger, much longer bull market, which is healthier for everyone. For an investment space, it's healthier for the actual nuclear fuel markets, it's healthier for the nuclear space in general. It's healthier for the utilities, et cetera. So all of these things are swirling around. We try to distill all of these things in our monthly newsletter. We've had a lot of new members come on recently as we just raised our prices. Welcome to all of you. And anybody who joins now or recently, you can access all of our content from previous months. You can go back and see the type of content we've been putting out the previous months and how we've been pretty prescient in determining what's about to happen in the market. In the short term, will we see seasonality return next week, 2 weeks from now? I don't know, and I'm not trading around it. However, these bouts of weakness, I have been buying, and I have been buying heavily. I've been, averaging down as the week over week we see another 5 or 10% drop. For me, I know the companies that are good. These are the companies that we recommend, and I feel very, very confident in this market. So I'm like a kid in the candy store when it drops, and it takes a long time to have that type of psychology in the markets. It's not difficult. I'm sorry, it is difficult, but it's not complicated. It's simple, but it's not easy. And it takes a long time and it takes some experience to have that thick skin to be able to weather these types of storms. But hang in there. A 25% drop in the ETFs, from the high print, you have to zoom out a little bit, right? If you're looking at just the drop from the high print, you're looking at a 3-week window. Go to weekly charts, zoom out and look. It's flat since November, or excuse me, since October. And it's still up huge on the year. And it's up huge on the 2-year time frame. So most of the time, these markets, when they reverse like this, these are opportunities if you are fundamentally convicted. All right, that's about all I'm going to say for now. I hope that you all are well. I hope that you have hung in there over the past couple of weeks and you remain confident in this thesis as I am. Take care. Thank you for being here, and we'll see you tomorrow. Cheers.